Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How is everybody doing? Hope you are doing well. Andrew Kuhn, Focus Compounding Podcast. Geoff Gannon, Focus Compounding Podcast. How's it going today?
It's going great, Andrew. How's it going with you?
It's not going good, actually. No, it's going great. Hope it's going great for everybody else. Thank you so much for tuning in with us. If you are on the podcast side of things, be sure to give us a rating and review. Help spread the word. Show some love. If you are on YouTube, be sure to subscribe. That will notify you every time that we upload a video. So I want to thank everybody so much for tuning in with us here today. We're on episode like 105 or something like that. Can you believe that?
Yeah, I saw.
We should have gone crazy on our 100th episode.
Yeah, we may not have even known what.
No, we didn't know, actually. We didn't know until after the fact. I was like, I should have had like fireworks going in the background and just going crazy, but we didn't. We missed it.
We'll do it when we have 100 video episodes.
There you go. Perfect. So today we're going to be talking about something that we've never talked about before. I really don't think we have. Interest rates.
All right, that's true. I don't think we've ever done an episode about that.
Yeah, what are bottom-up guys talking about interest rates? I don't know. Why are we going to talk about it? But it's a good topic that we haven't talked about. It's been in the news a little bit more recently because the Fed just cut the rates by 25 basis points. So everybody was, obviously tweeting and talking about that. It's all over in the newspapers. Donald Trump was very upset. He wished that they would cut more. At the all-time high. He says that the market will shoot up like a rocket if they cut. So I think that's kind of interesting.
I don't think I've ever heard of a president wanting them to raise rates.
Yeah, and that makes sense too, right? And he, when he, I guess you could say, was going to benchmark his success against the Dow, you knew that he was going to do whatever it took, quite honestly, to whether right or wrong. We're not here to debate that, to continue, propping the market up. So another thing I thought was interesting too, and gosh, we're going to get political here, I guess.
Okay.
Was that when he was... Wasn't it when he was campaigning? He said that with the Fed artificially keeping interest rates low, that they're hurting the earners, or like the savers, the baby boomers, people in retirement, for yields. Gone are the days of you retire, you buy some bond for 7%, and if you retire $1 million, that's a pretty good life, right? I think that's how it was when my great grandma retired. But he was criticizing the Fed for that, for wanting for them artificially keeping interest rates low.
Right.
And now he's chirping for them to continue to cut more. So I thought that was kind of interesting.
Well, when you're not in office, you criticize things that are going on, and then when you are in office, you want to make sure that the things that are happening are good that you're doing. So
you
don't. When you're not in office, you talk about how America is not great, and then when you are in office, you talk about how things are going well. But it's true for all politicians that way.
Yeah.
Once everyone take foreign policy or something, usually every president criticizes some of the foreign policy of their predecessor, and then they adopt the same foreign policy when they get in, which might be because of what people tell them what's good for when they learn about all these things when they're in office. But it can also be that you have to find something to criticize when you're not, when you're running and someone asks you a question, you have to come up with a critical answer. You can't say, "Oh no, I agree with that. What's going on now? It's all good. That's the way it should be. That's why I'm running."
Again.
Don't
vote for me. Vote for that guy. He's doing a good job. I thought that was interesting. But anyway, so very long-winded.
Okay.
Let's get to it. So, interest rates.
Yes.
How do you typically factor in interest rates to an investment?
So that's a very good question. So the simplest way is that in theory you should be using some sort of discount rate to be valuing stocks. And Buffett has talked about this before. In practice, I'm not sure you really do that exactly. But the way that people like to think about it is to use the long-term government bond or something like that. You'll often see on TV, I think, that newspapers and things like that, they'll use the 10-year government bond. And that will sort of be their discount rate for doing different things. And then you add to that for adjusting for risk and things like that. Now, that's not how I do it, but I do compare any investment versus the alternatives that you could have. So for us, whether making a decision about buying something or not is the next best alternative of buying more of what we already own or something like that, which it is for Buffett as well. In terms of discounting things for stocks, I use the long-term expected return that I have for the S&P 500.
And the way you typically think about that is, what do you think is that long-term return?
Oh, like around 8 to 10%.
Yeah. So
historically, now I don't expect it to return anywhere near that going forward from here. But historically, I would say that if you look at a stock and you're pretty sure it's going to return less than 8% a year, you shouldn't buy it.
Yeah. The way I think about it was like 7 to 8%, and then I tack on our fee, so 2.5%.
Oh, okay.
So you kind of benchmark it for our clients.
Okay.
If it makes sense to invest in that company.
Yeah. And if the stock is likely to return more than 10% a year, that should outperform the S&P 500. That's the simple way of thinking about it. But of course, the timing is what matters. So in reality, over the last 10 years or something, you would have underperformed with that number. But over the last 20 years, you would have really outperformed by a lot.
Yeah.
So because the S&P had a bad first 10 years and then a really good 10 years after that, it isn't very predictable how it has those returns. And that's the problem with interest rates too. You can use interest rates as discount rates, but the problem is how much they will change over time. And that's a really big problem, because you would be adjusting whether it's a good idea to buy something or not based on the fact that, if we go back to when Buffett bought Coke or something, you're talking about bonds that were priced at, they're now priced like 5 times higher or something in that neighborhood, maybe 4 times higher today than they were then. The same amount of coupon is priced by the market at like $4 or so more than it was. So it's, in a sense, if you're looking at like PE ratios, it's as if the bond market is saying that the same amount of interest is worth 4 times more now than it was, now about 30 years ago. And that is something that I think is too difficult to use in your predictions, especially because if you look at things like the Fed funds rate or something, there's very little relationship between what it is today and what it will be in like 15 years or something. So you're buying an asset, a stock, and a lot of the cash flows that you'll be getting are in later years. So a significant amount of the value in a DCF type approach is going to be in later years, like past year 10. And that's a big issue because you have no idea what the interest rates will be in later years, which is when you'd be reinvesting the cash flows. So actually, you might be able to value it today, discounting it, right? Mathematically, you could go into Excel and do this, but you aren't being guaranteed that interest rates will be the same. So your alternatives in buying something else, buying a bond or something, won't be the same. And that's true. If you look at like people input into their analysis of like a bank or something, today's Fed funds rate. Well, that's good for an analyst trying to model out earnings this year, next year, the year after that. They don't have to go beyond that. But for an investor, a long-term investor, Buffett's owned Wells Fargo since like 30 years ago, that's not good because the Fed funds rate will be so different in later years. And you see constantly that it goes from a period where it had some of its lowest levels to 15 years later being at some of its highest. And knowing what inflation is today doesn't really help know what it'll be in 15 years. Mm-hmm. It just doesn't. It didn't help it going back the same way. And people put in today's number, but it isn't useful. And so a long-term average might be more useful. That's one way to think about it. So long-term average inflation, long-term average interest rates, Fed funds rates, whatever rates you happen to be looking at, might be useful. The S&P 500, same thing. You use a discount rate, the very long-term average, I said 8 to 10% or something, rather than what if it's been up 18% a year for the last 5 or 10 years or something. Do you use that rate? Some people think that today's interest rates are normal, for the future. But they thought that years ago. If you have to read a lot of things from a long time ago to get a better sense of that, because they were convinced that inflation would never be down to a level of a few percent again. When inflation was very high and interest rates were very high, no one expected it to return to the level seen right after like World War II or something. But today's levels are like the same as the levels right after World War II. So they went up for 30 years or so, and then they went down for 30 years or so, the rates. It feels like a huge difference to people because it's a whole investment lifetime. There's just one cycle over an entire person's investment career. A professional career will have basically just one cycle in interest rates. That's how long it is. And for stock markets, it's pretty close too, like a really long bull market and then a bear market, whereas the economic cycle is so much shorter that people are used to the idea that there's recessions and there's booms and busts, and it's not something that's permanent. They understand that recession won't be the last recession they'll ever see, or that they understand that there will be a recession again one day.
Yeah.
Yeah.
How do you think about interest rates in relations to like actual businesses. I mean, lower interest rates is probably good for companies that, I mean, cheaper debt if they want to take out that.
Yeah. And I talked about this with you before we recorded, which is that I got a lot of questions about this when I did a normalized PE thing back in like 2006 or something I wrote about on my blog. And the thing is that it's, in people's perceptions, the Fed sets these things.
Yeah.
They decide these things. And they do. They vote on it, and that's the decision that's made. But what this person had asked me to do is to look at how changes in the Fed funds rate, rate cuts and things like that, had an effect on earnings from public companies. And I said, oh, well, actually looking at this, it's much easier to figure out the reverse, that you can predict better what the Fed will do based on what's already happened with corporate earnings. So like right now, as we're recording this, corporate earnings have been down for like a year or two. So in essence, public companies in the U.S. are in a recession, right? Now, that's not how you define a recession, but if you use that as the definition of a recession, then you can see that the Fed will cut rates in the future, whereas the Fed can raise rates a lot over time for several years if earnings keep going up a lot. So in a sense, it's responsive, right? So you can think that the Fed's doing all these things when in reality, it's responding to different conditions. And so that's a big part of it. When we talk about like whether interest rates being low is good for a business or whatever, you have to remember that a lot of times it's the reverse of what you think. If companies take on a lot of debt and don't earn a lot to service that debt, they will go under unless someone gives them lower interest rates. Sure. They need it. We've talked about this especially, I think, to me right now, the one where it's really obvious is in China right now. China's in a situation where higher rates would be and China's rates basically are tied to U.S. rates, would be very bad for their corporate sector if they had higher rates. And that's not just because they borrowed a lot. They did borrow a lot, but they borrowed a lot and then they invested in low returning sorts of things. And that's really the key. If a company borrows a lot of money and just keeps it on the balance sheet, it doesn't matter. But if they borrow a lot and then invest in projects which are earning 5% return on their money, they can't have 6% interest rates. You can't do it. You can't finance with all debt and then have returns that are worse than what it takes to cover that interest. And that's when we talk about like zombie firms and all that, which are companies that are just existing to pay their interest. They can't reinvest in things about their business. That's what happened in a lot of places in years ago in Japan and things like that. And it has that threat of happening in places like in definitely with some Chinese companies, it will happen because they borrowed a lot of money that they invested at levels that are too low versus what interest rates may be in the future, which means either they'll go under or they'll need infusions of cash or something if interest rates rise, or someone has to keep interest rates low to keep them producing at the levels that they are and keep them in business. And, but that's sort of the same thing as we could be talking about energy or something, right? You could find a price at which you'd say, oh, well, if oil prices drop below $40 a barrel for a significant amount of time for this company, they won't survive. They need it above that level. It's exactly the same thing with companies that borrow. If they're investing in things that aren't that high returning, right, that they're getting the cash flows off of, they can't service debt at higher interest rates. But lots of companies can service a lot of debt if interest rates are very close to zero. And the problem with corporate ones especially is that a lot of them borrow really short term. And you saw that with the financial crisis and things like that, that it wasn't just borrowing a lot, but borrowing a lot very short term can sometimes have very, very low rates depending on how steep the yield curve is, right? So if you look, the rates for like 30-year bonds, corporate bonds and stuff, they don't move around nearly as much as very, very short-term rates. So if companies were using commercial paper and things like that, then that could be much more dangerous. And so I think there's a book that Howard Marks wrote on the cycle.
Mastering the Market Cycle.
Yeah, exactly. And you could read that to get a better idea of what's important, which is just understanding like these extreme. What you're worried about is things that are, you're not worried about one standard deviation. You're worried about three. You're worried about things that happen once in 30 years or beyond. You're worried about things that seem like there's more borrowing going on than there should be and stuff. I mentioned China. If you look at the last 10 years, the buildup of debt in their corporations has been, the percentage increase has been astronomical. It's been like something I've never seen before. That tells you be careful. And that's true. Housing prices in certain countries, stay away from that area. And that's, in terms of investing, that's usually the best way to do it, is just to understand what things are in an absolute boom, what's an absolute bust, and to look for opportunities to buy things after a bust, and to avoid things that are in a boom. When a lot of times when people say, well, this is normal, this will continue, to be careful about that. Today, the thing to be careful about is anyone relying on low rates, right?
For the
because
business.
even though rates might be going down in the near term, right? We just had a rate cut. So you could assume, okay, well, rates are more likely to go down than up, and you can see market things that price that in. That's not that important for an investor in a stock. Stocks get most of their value from very long-term cash flows. So the life of a stock, in terms of if you're trying to compare it to a bond, is extremely long. It's like buying the longest long-term bond you could imagine. It's like buying a perpetual bond. So you need to worry more about the long-term average of what's going to happen. And it's very easy for companies today to think it's safe to borrow a lot because I can refinance it and I can pay low amounts of interest. What if it happens that in the future I would have to pay a lot for that and have difficulties? And so you can look for opportunities that way. Banks and things, I've seen compared, people like just as much the banks that pay a lot for CDs and things now relative to the banks that pay almost nothing in their non-interest bearing stuff. Whereas in a higher interest rate environment, there would be a big difference between those two banks. But right now they look kind of similar because both banks aren't paying that much for their deposits. But one has a much higher quality deposit than the other one in times of higher interest rates. And the same thing's true with borrowing short term versus long term. That's a thing to worry about. Well, people listen to this now, if you're not been investing that long, it's very easy. There hasn't been a recession in a long time, long time. And there hasn't really been a contraction of credit. So the last thing that people would remember of that is the financial crisis, which was unusual in a different way. So the next time will not look like the financial crisis, but it also won't look like the last 10 years. Something will happen eventually that will cause people to be a lot more reluctant to lend to certain things, to finance certain things. And we sometimes talk about those a little bit here, where IPOs of different things and stuff like that, where they're just so willing to finance companies which wouldn't exist otherwise. I've mentioned before, like WeWork. WeWork is an example of a company that in a different economic environment probably wouldn't exist. It wouldn't be this size. It wouldn't get this funding. Because of that. But that was true. That's true of what built up Amazon. Amazon was able to go public and to have a huge market cap and stuff at a time when the company was very small, and in any other market environment that wouldn't have happened. But that was a mania in .com things. Now there's some things in venture capital stuff, but also just things in terms of ability to borrow. That companies have, that a lot of companies can have bonds and loans that are traded by banks and things that you wouldn't have in normal times. And so it's that book, I think, is probably pretty good to read that way. Although just his memos in general are, I think, even better than the book. Because he worries a lot about the cycle, and it's just to be aware of the things that are really unusual. That's the most important one. Is don't invest in that oil.
It's extremes.
Avoid that oil company when oil is at an all-time high. Avoid things that depend on having very, very low interest rates when they're that low. Don't bet on interest rates one way or the other, though, because we talk sometimes about how we focus on like overlooked stocks. So we'll talk a little about market efficiency in terms of so many people are focused on interest rates, right? That your abilities to predict it compared to other people is not going to be very good. It would be much better your ability to predict specific things about specific companies. So what you definitely don't want to do is what I get a lot of emails about, which is basically someone says, I think rates are going to rise. I think rates are going to fall. I think inflation will be this, whatever. Now I want to find stock ideas based on that.
Or taking like a top-down approach and then finding ideas off that.
Or I can't buy this company because I'm really worried that the dollar is going to fall, that this is going to happen. Those macro things that they have form this belief about, and then they decide that means I can't invest in this thing, or I should look for other things to buy that way. And that's not the right way to do it. The right way to do it is to look in certain areas where things are out of whack. So it's when rates were at 0 to 0.25%, that's the time to look for things that might benefit from higher rates, just because the likelihood of rates being higher in the very long term is so high. The same thing if gold or oil or whatever is at an unusually high price. And there are just ways of statistically this works fine. Even if you don't know anything about what's driving things in the prices, if you see levels that are really unusual statistically, just in terms of the variation, in terms of standard deviation and things like that. That, let's say the mean for this is that the Fed funds rate has been 3 to 4% or something. So if you see numbers that are saying 0 or 8 or something, that's when you start to pay attention to it. And you try to, the things that happen are when people sort of take what's happening today as if it's going to happen forever. That's usually where the opportunities are. That they start to assume, okay, well, the situation now is what it'll be forever. So if you can find something where you'd benefit from like a reversion to the mean, like the very long-term mean, that's a really good way of doing it. But don't start and then pick from there based on like having an opinion about interest rates.
Sure.
Like how would you form an opinion about interest rates?
I would probably say, interest rates they're low. They probably can't stay this low forever.
Okay. But I mean, you said you read the Wall Street Journal and stuff. There's a lot about interest rates in there.
That's
so what would someone do? Like, would they look at expert opinion on it? Would they?
Probably. Yeah. I mean, but nowadays you don't know, right? Just look at Twitter.
Yeah. But I mean, so the way in which people would form opinions just isn't a very good way for getting a better opinion than the group, right? Yeah. So when you're looking at a stock, you might be looking at it differently. You might be reading a 10K that a lot of other people aren't reading. And then you might be trying to do that in isolation, learning about the company and everything, and then only later figuring out what people's opinions are about it and stuff like that. You really could form a variant opinion that is accurate in a way that the market could be wrong about. But I see that as being very hard to do in something like interest rates.
Do you spend a lot of time thinking about interest rates? Because I don't think about it at all. Yeah.
I don't.
I mean, I follow along. Obviously, I know what's going on, but I don't really think about it.
I don't spend as much. I don't spend much
I'm not
time.
Like banks or anything like that,
right?
Where it's more susceptible.
I don't spend as much time looking at interest rates as you'd think, but I do immediately eliminate ideas. Because of things that have to do with interest rates.
Yeah.
So we talked a little bit about currency before. Currency is affected by interest rates, differentials between countries. Interest rates also affect certain things, stock prices, but especially land prices a lot in different places. And it does mean that sometimes I say no to things purely because it feels like a bubble. And while I don't know if it is exactly a bubble or not and whether it will pop and things like that, I'm just going to avoid that area entirely.
Where do you think there's a current bubble or things that you would avoid?
I would avoid... Well, I would certainly be careful about any countries which are relying on... that can't set their own interest rates. So countries that are using currency pegs to other currencies. They're very sensitive to... So what you do is, say you have a currency and you want to make sure that that currency doesn't fluctuate on its own. Yeah. You have you would say, okay, so this will be for every... you get 8 of this local currency for every $1 you have or something. And that's what it'll always be. Well, when you do that, you'll notice that the problem is, what if your country, you think that you should have a 1% interest rate, and the U.S. starts saying we should have a 2%, 3%. You now have a problem because you've pegged your currency to their currency. They have to stay at the same level. So you're basically having to import the U.S.'s interest rate policy, which you may not want to do. And I think people might underestimate how serious that can be in some countries. Yeah. If it's held for a really long time, people forget about it, that they're doing that. The people in those countries forget what's happening. And it's not just the U.S., by the way. There are other countries that do that. There's some that are pegged to the euro and things like that. But by agreement. So they will say, and the government will always say that they'll hold the peg and whatever. And they will say that until 11:59, the night that at midnight they break the peg. But those sorts of things are what you have to be careful of, because it's something where people take it for granted completely that way. And the same thing is true also on anything that's gone for a very, very long time. Like I was talking to someone where in a country where basically home prices had... the affordability of homes in terms of interest rates in the country mortgage rates had basically been making homes more and more affordable for people for the last 22, 23 years consecutively, with no declines in that. So prices may have declined a little bit momentarily in like the financial crisis or something, but you could... If you had the same job, you could afford a bigger and bigger house every year, basically. You could afford to pay more and more for your house. What that does, though, is that people start to assume that the price of homes will rise. And they don't realize that for the last 25 years, the price of homes has been rising faster than wages. Logically, I'm not sure that you that's sustainable, right? That wages are what's paying for the home.
Sure.
But it is sustainable as long as rates are declining. So when it reverses, it becomes a problem. So I would avoid things like that. There are certain markets in terms of homes and things I would definitely avoid. Certain real estate markets in certain countries, and you could probably figure that out by looking into it, looking at how unusual it is. That's the big thing, though, is that people don't treat it as unusual. So they just look and they assume that any country's real estate market must be the same, right? They're like, oh, well, I'll value this company on price to book or EV to EBITDA or whatever, when really one's in a bubble and one's not. And it's totally different depending on that in the cycle.
What was your opinion of the Fed lowering rates? Did it surprise you, or
It did not
did you have any
surprise
thoughts
me.
about it? Yeah.
It never surprised me because they spend so much time telling you ahead of time basically what they're
I
going
mean,
to
it
do.
was already kind of priced in, right?
Yeah. I mean, in terms of like, would it make sense or something? How would I vote and stuff? I have no idea.
Yeah.
I think I've said before, I know I said to you that it probably rates, if the U.S. didn't trade with the rest of the world and stuff, probably rates would need to be higher than they are now.
Yeah.
And if you were just setting rates for the rest of the world, not the U.S., probably lower, especially China. China needs lower rates right now. Whereas China and the U.S., I think, are going to need very different interest rates
So
eventually.
since we're on this topic of macro stuff, what about tariffs? How do you think about tariffs when it comes into investing?
Well, I don't invest in anything that relies on tariffs.
Yeah.
And some companies benefit from it. And also don't believe the political stuff you hear in terms of what investments you make. So, for instance, you'll read things that will say something like, "Oh, tariffs are paid for by consumers" or something.
Yeah.
They might be, but if you're investing in Walmart or Target or something, do not assume that all of them together can raise prices.
Yeah.
Because it's not true. So what will happen is, if they could all agree, if they could all work it out together that they could raise prices, then they would. But if anyone in the group thinks that they can benefit by keeping prices the same despite higher tariffs, higher prices for them bringing things in, then they won't raise it. And so businesses will suffer. And I read a lot of things where people don't I read a lot of things, whether it's tax things and tariffs of tax or anything else like that, where they assume that the full amount of the tax is paid by one party, really. So, payroll tax or something, they say, well, that's paid by the employer. This one is paid by the employee. Corporate tax cut, they think benefits only the corporation and not that corporations might do other things where they will benefit other people or vice versa. And in reality, it depends on your competitive situation. So like when someone says something about tariffs, it really depends on the microeconomic structure of the industry that you're in. In certain industries, it's just a benefit to the domestic producers if you have a tariff, and then their customers suffer from it, right? But in other industries, it's not necessarily just a benefit to them because they don't have in place a situation where they could force someone else to pay the tax, basically. So it's always talked about as if taxes just hurt the consumer.
Sure.
When in reality, it may hurt a lot of the businesses that do things that way. In certain businesses, it would be very disruptive if it were to happen with certain countries. So the big ones would be companies which produce entirely in one low wage countries and export entirely into high wage countries where that could happen. So like, a Nike
Apple.
or something like that. Apple, yeah. But I think usually it's way exaggerated in terms of the effect that it would have on the businesses, and the stock price movements are way too big. I'll give you an example. Because what happens generally is that the hot topic of whatever political thing or something gets all the attention, and that's not usually the most important topic in terms of like figuring out a stock to buy or something.
Yeah.
China and the U.S. have tariffs and things. They're in some sort of trade war or lead up to it or coming down from it or whatever. It's in the paper all the time. What's less in the paper is that there is a disease in China killing pigs, right? Infecting pigs, and then they're destroying them. However, in terms of your stock picking, the issue with pigs is way more important to individual stocks that you could buy or decide not to buy based on that, because of the huge difference that will have in the U.S. sending pigs to China, sending pork to China, and in prices in the U.S. Just because of all sorts of factors about, one, how quickly you can respond to that. So life cycle of pig a lot shorter than the business decisions we're talking about with tariffs.
Yeah.
And just in terms of what that will do in prices, it'll have huge effects on some U.S. companies. And it's in the news but I don't think it's discussed nearly as much as tariff things, which sometimes for some companies aren't that big. For some, they're big. For Apple or something like that, it could be really big. But for a lot of companies, we're talking about a pretty small impact from tariffs. And I think that it makes more sense to worry about the really big things that affect a company. And like I said, that, for instance, like pork or something, that's a much bigger story in the pork industry in the U.S. than tariffs overall. In terms of you picking out particular stocks,
sure.
Yeah, I can't think of that many stocks that are so affected by tariffs that it's a huge difference for them. Because in general, the thing is, if you want to avoid situations where your company that you're looking at investing in is being affected by a tariff that isn't also hitting other companies.
Yeah.
So it would be this situations in which, like, say a company is importing things from China to directly compete against other companies which are producing the same product in the U.S. That's not a very common category. Mm-hmm. I can't think of many things where one company has chosen to import all of their production from China and another company has chosen to produce everything still in the U.S. Mm-hmm. It doesn't exist much. Mm-hmm. Yeah, we get like all the shoes and clothes and things from other countries, but there's almost no one in the U.S. who still produces them. So it doesn't matter in that way. If you had a business model built around importing things, whereas your competitor didn't, it would be devastating to you. But that's not common, So, I mean, it's always those competitive things that are more important to focus on, because if everyone in the industry is being equally affected by it, it doesn't make a huge difference. Yeah. If everyone is or it's the reverse, say you're all producing washing machines in the U.S., well, the tariffs all will help you and hurt your competitors from importing them from other countries. Yeah.
No, it's interesting. It's definitely an interesting topic, and both of interest rates and tariffs obviously are in the news every single day.
They're always in the news. Yeah.
I thought I would ask about it, but cool. Well, I want to thank everybody so much for tuning in to today's podcast. If you like the work we are doing here, feel free to give us a rating and review. Be sure to subscribe to the Focus Compounding Gazette at focuscompoundinggazette.com. Everything's in the show notes. I want to thank everybody so much for tuning in. We'll see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.